Yo, what's really good, people? Welcome back to Infinite Investors, the home for all new and non-investors. I'm Curtis, and today I've got a really quick video. I wanted to explain what the recent Fed drop in rate means for investors. So, if you want to know in a simple, clear, and transparent way, please subscribe to the channel. Please like the video. I'm on a mission to get to 2,500 subscribers and get the world of investing out to more people in a clear, transparent, and simple way. So guys, as you know, the Fed dropped their rate. I think it was 0.25%. And what people have been asking me is, what does that actually mean for my investments? What does that typically mean for my investments? Now, I have alluded to the impact of a drop in rate from the Fed, or whether it was the Bank of England, whoever's the central banking authority in a region. I have alluded to what that means in previous video, but it has been kind of piecemealed as just sort of information that's available within those videos as opposed to a dedicated video. So I wanted to just try and explain that for you in a clear and simple way. And it's very easy to kind of grasp and understand. When the Fed drops their rates, what this means is that lending is therefore cheaper. So people that are borrowing in terms of personal loans, in terms of mortgages, and also the rates that at which banks borrow money from other banks. So what you'll find is that banks exchange money, multi-millions and billions pounds of money, or dollars of money, on a consistent basis, and the rate at which they do that will be cheaper. So when rates are cheaper, it does mean that more money will be flowing, there'll be more purchases, there'll be more consumer spending, because the cost of items, the cost of borrowing tends to be cheaper. And what that then means is that it's a positive effect on the stock market, because when more people are borrowing, they're obviously using that borrowing to spend, and they could be spending it on cars, or they could be spending it on houses or home improvements or a whole bunch of other factors. And that means those businesses are benefiting from an increase in spending, which then means the businesses that you and I have invested in should hopefully have better earnings, better revenue, better profits, and therefore their share price should increase. So in short, a drop in the rate should have a positive impact in consumer spending. An increase in a rate should have the adverse effect. So typically when a central banking authority is trying to curb spending for a number of reasons, they might increase the rates, and basically an increase in those rates would then effectively mean that people will borrow less money, and therefore spending might decrease, and therefore when spending decrease, the sales of a business will decrease, in theory, and obviously then potentially the share price might decrease. And then this is a constant, ebbing and flowing of what a central banking authority might do in terms of controlling inflation, controlling consumer spending, and controlling the sort of growth of an economy. So as things currently stand, a decrease in rates should be a good thing, especially if you've invested in UK equities. Now, the only consideration here is if you've invested in banking stocks. If you've invested in banking stocks, then typically a decrease in the rate would actually have a negative impact on banking stocks, because they're the ones that are borrowing money or lending money. And because they are borrowing money either from other banks or lending money either to other banks or consumers, they're doing it at less of a profit, and therefore that will basically mean that a bank's earnings will decrease. So what you've seen from my portfolio, and you'll see in my next portfolio update, a lot of my banks have dropped considerably, and some through microeconomic reasons from them banks, typically themselves, but also through this whole macroeconomic shift in the market. So generally, that's how interest rates affects the market. You can't predict it on a one-on-one basis. So what I mean by that is that you could have two banks. One could have a great individual performance. One could have a terrible individual performance. The Fed cuts their rate. It might not fully change both the positive and negatives banks to be identical. The positive bank might still be positive. So you won't have it, fully the same for everybody. But it is a strong indication in terms of how things like that is going to move and play out in the forward. I'll leave this link in the description. This is a nice article from Investopedia that explains it, maybe hopefully better than I do, but hopefully you found this useful and interesting. I'm going to produce a few more videos like this, just explaining a bit more how macroeconomics can have an impact on your stock market investments. I've got some videos already there, how inflation affects you guys as investors, so definitely go and check that out. Hopefully you found this video useful. Please like, please comment, please subscribe, and I will catch you next time with another investment video. Happy investing.